Hello, Jim. My employer 401k plan through Fidelity does not allow for a diversified portfolio and offers funds with high expense ratios, except for a target date fund. I exchanged my 401k into a Fidelity brokerage link where it can be invested in many more options. Have you heard of any issues with this? Secondly, a few years ago, I started investing in my taxable brokerage account and did not know about the tax ramifications of REITs, small value funds, bonds, etc. at this time. Since then, I no longer contribute monthly to these assets in my taxable accounts. The gains are probably a few thousand total. The tax drag is around 0.4%. Should I sell these and take a capital gains hit or keep them in the account? Also, if my gains overall each year are greater than the tax drag, then why wouldn't it still be worth it to keep investing in these in my taxable account as long as they're earning a good return? Thank you. And thank you for everything that you've done through your podcast.
Okay. Yes, Fidelity Brokerage Link is fine to use. Schwab has something similar called the PCRA, Personal Choice Retirement Account, I think is what it stands for. But basically, you get to opt out of the mutual funds that your employer has selected for you, and you can invest in anything available at the brokerage. That includes all kinds of stuff most of the time. Just about any ETF that's available out there that's publicly traded, any publicly traded stock or bond, etc. So you usually have to sign some sort of waiver or disclaimer saying you know what you're doing to do this and you're taking all the risk, because normally those sorts of assets aren't necessarily allowed in a 401k because your employer has a fiduciary duty to you to provide you good investments. Incidentally, if all they've given you is a crummy list of expensive actively managed mutual funds in your 401k, you might want to remind them that fiduciary duty, that some employee might come along sometime and sue them for not, taking that duty seriously. But in the meantime, you can just use the brokerage link. No big deal. I've done the same thing in my partnership 401k. We have a PCRA option. It's via Schwab. And so I've used that for years and years and years. It's no big deal. The main reason I did it wasn't actually because the investments in the 401k sucked. Ours were fine, but the fees were slightly lower to roll my own investments by going through that PCRA. And so that's fine to use. Your second question is an asset location question. And the point of asset location is to eke out a little bit of extra return by being smart about where you put your various assets, which ones go into tax protected accounts, which ones go in a taxable account. And so in general, you want assets with a really high return and assets that are very tax inefficient in tax protected accounts, because you want those accounts to grow so you can benefit from the tax protection on even more money in the future. And of course, the less tax efficient it is, the better off it is in those tax protected accounts because you get to keep the entire return. REITs are notorious for being tax inefficient. They do benefit now from the 199A deduction, which helps a little bit, but they're still pretty tax inefficient because they have relatively high returns, and they've got, most of that return comes from a distribution that is taxable at ordinary income tax rates. Bonds, particularly in times of high interest rates, are also tend to be pretty tax inefficient, so they often go in tax protected accounts as well. It sounds like you've learned this somewhere and are thinking about making corrections in your portfolio, which is appropriate. If it doesn't cost you much, why not make the correction? But when we're talking about stuff you have in your taxable account that you don't really want there, the term we use for this is legacy assets or legacy investments. And sometimes it's some actively managed mutual fund. Sometimes it's just a mutual fund you just don't want in taxable. And so you've got to weigh your options there. Sometimes it makes sense to just leave those there and build around them. Obviously you don't want to be reinvesting dividends or distributed capital gains, but you can build around those things if you don't want to take the capital gains hit. If you give money to charity, these are great assets to donate to charity instead of cash. You can put them into your DAF or you can give them directly to the charity. As we talked about last week, you can use them in a CRT or a private foundation or whatever. But that's a great way to get rid of them. You can also just hold them until you die and your heirs get a step up in basis on those. But if it's just a few $1,000s in capital gains, you may want to pay the taxes on that just to simplify your portfolio and be done with it. It really depends on how badly you want a simplified portfolio. Other things you can do in the next down market, maybe you can do some tax loss harvesting, and then you'll have enough losses that you can now offset the gains when you sell those legacy assets. That's another option you can use. Or if you already have a bunch of tax losses, you can use those up to get rid of those and move them into, whatever tax protected account you would rather have them in. But don't beat yourself up too badly. I mean, the way this goes for a lot of people that are really good savers, especially if you have a decent income, is your taxable account keeps getting bigger and bigger and bigger over the years and becomes a bigger portion of your portfolio. And so at this point, I've moved most of my asset classes into my taxable account. My US stocks are there, my international stocks are there, my small international stocks are there, an increasing percentage of my small value stocks are there, a fair amount of my real estate is there, the vast majority of it actually. I don't have my publicly traded REITs there yet, but someday they may be in taxable as well. And I've got a big chunk of my bonds there now in a muni bond fund. So don't beat yourself up too badly. Realize that there's a lot of people that end up doing that just because they have to, because the ratio of taxable to tax protected accounts is just too high in order to have very much in that tax protected account at all. Remember, asset allocation first, then tax location. Don't let your tax tail wag your investment dog, but do try to be smart about where you put your assets, and you can eke out a little bit more return by doing that. If you want your questions answered by the White Coat Investor, record your question at whitecoatinvestor.com/YQA or click the link in the description.
My dad, your host, Dr. Dahl, is a practicing emergency physician, blogger, author, and podcaster. He is not a licensed accountant, attorney, or financial advisor, so this podcast is for your entertainment and information only and should not be considered official, personalized financial advice.